Have you ever stopped to think about the hidden machinery that keeps our financial world from, well, grinding to a halt? We hear about these giant corporate loans all the time, but behind them is this incredible story. A story about data, about teamwork, and about a quiet network built specifically to stop disasters before they happen. Let's pull back the curtain and see how it all works. So let's start with a really simple but kind of mind-boggling question. If a huge company needs $100 million, or heck, even $1 billion, where do they get it? I mean, what bank just has that kind of money lying around and is willing to bet it all on one single loan? And the short answer is they don't. No single bank is going to take on that kind of risk. It's just too big. If that one loan went bad, it could be absolutely catastrophic for the bank. So if one bank can't do it, how in the world do these massive deals get done? Well, this brings us to the whole concept of the too big to fail loan. The financial world had to figure out a way to fund these enormous projects without putting any single lender in a position where one bad bet could just wipe them out. And what they came up with is called syndicated credit. It's actually a pretty brilliant idea when you think about it. Instead of one bank fronting all the cash, a whole group of them, a syndicate, get together and each chip in a piece of the loan. That way, that huge, scary $100 million risk gets sliced up into smaller, much more manageable chunks.
But you know how it goes. You solve one problem, and you accidentally create a brand new one. By spreading the risk out so widely, a new danger emerged. If everyone only holds a tiny piece, who's actually watching the entire loan? Who's looking at the whole picture?
This created what you could call an information fracture. Think about it. A giant loan gets made. It's chopped up among, say, 20 banks. Each bank looks at its little slice and says, yep, this looks okay to me. But nobody, not a single one of them, can see the total combined risk. And just like that, the true danger of the loan becomes completely invisible. So this invisible risk was a ticking time bomb. The only way to defuse it was for the regulators to do something pretty radical. They had to team up. They needed to build a shared lens, a central database that would let them piece all that fractured information back together and make the risk visible again. And that solution is the Shared National Credit Program, or SNS for short. It was actually started way back in 1977. It's basically a massive, joint effort to have regulators review and analyze every single one of these giant syndicated loans, specifically any loan over $100 million that's shared by multiple banks. You've got three of the biggest financial regulators in the U.S. running this thing: the OCC, the Federal Reserve, and the FDIC. They all came together with a really clear mission: to create one single, consistent, and totally unbiased view of the risk that's hiding inside these enormous loans. Okay, so what does this regulatory task force actually do? When they look inside this massive shared credit database, what are these, financial detectives actually looking for? They dig into everything. They're looking at the borrower's financial health, they're scrutinizing the fine print in the loan agreement, checking the collateral. But here's the most important part. They compare how each individual bank is rating the risk of its own piece of the exact same loan. Now, this slide shows you exactly where the magic happens. Look at this. You've got Bank A and Bank B both saying loan X is totally fine. They give it a pass. But the SNC program, because it has that unified bird's eye view, flags it as a special mention, which is basically a warning flare. This is the system in action, correcting for those individual blind spots and forcing everyone onto the same, more cautious page. And look, this isn't just some academic exercise in collecting data. This whole process of creating a single, unified picture from all these scattered pieces, it has a real direct impact on keeping our entire financial system stable. And the system has had to evolve. After the 2008 financial crisis, you can bet those reviews got a whole lot tougher. And today, the program is totally zeroed in on new kinds of risks, like so-called covenant-light loans that have fewer protections for lenders. It has to keep adapting because the risks are always changing. So here's where the rubber really meets the road. The data from this SNC database, it directly affects a bank's official regulatory report card. It can force a bank to hold more emergency cash to cover a risky loan. And it helps the people at the top spot dangerous trends across the whole country before they spiral out of control. I think this quote just nails it. These massive loans create this incredibly complex web that connects all of our big financial institutions.
And the SNC program is the hidden database. It's like the central nervous system that monitors every single one of those connections to make sure the whole system stays healthy.
It really makes you wonder, doesn't it? This is just one story from our database, history, one giant, unseen data network that's designed purely for stability. What other invisible databases are out there, humming away behind the scenes, quietly keeping our complex world from flying apart?